Derivatives play a central role in modern portfolio management because they allow investors to modify risk exposures efficiently without significantly changing underlying asset holdings. Portfolio managers use derivatives to adjust market exposure, hedge unwanted risks, implement tactical views, and enhance operational flexibility. Compared with cash market transactions, derivatives often require less capital, involve lower transaction costs, and can be executed more rapidly. Their value lies in the ability to separate specific risk exposures from physical asset ownership and manage them independently. The program emphasizes that derivatives are not merely speculative instruments. They are essential tools for achieving targeted portfolio outcomes, improving efficiency, and aligning portfolios with investment objectives and constraints. One of the most important applications of derivatives is asset allocation management. Portfolio managers frequently use futures, forwards, and swaps to increase or decrease exposure to particular asset classes without buying or selling large quantities of securities. For example, equity index futures can quickly increase equity exposure when a manager has a bullish outlook, while bond futures can alter interest rate sensitivity. These adjustments can be implemented rapidly and with minimal disruption to existing holdings. Derivatives therefore enable managers to respond efficiently to changing market expectations, maintain strategic asset allocation targets, and execute tactical investment decisions while preserving liquidity and reducing transaction costs associated with cash market trading. Derivatives are also widely used for portfolio rebalancing. Market movements can cause portfolio weights to drift away from target allocations, creating unintended risk exposures. Rather than immediately trading physical securities, managers can use derivative contracts to restore desired exposures efficiently. Futures contracts are particularly useful because they provide broad market exposure and can be implemented quickly. Rebalancing with derivatives often reduces trading expenses, market impact costs, and administrative complexity. This approach is especially valuable for large institutional portfolios where buying and selling underlying assets can be costly and time-consuming. As a result, derivatives enhance the precision and efficiency of maintaining portfolio policy objectives over time. Risk management is another major application of derivatives in portfolio management. Interest rate derivatives can hedge duration risk in fixed income portfolios, while currency derivatives can reduce foreign exchange exposure in global portfolios. Equity derivatives can protect against adverse market movements or modify portfolio beta. Options provide downside protection through strategies such as protective puts and collars, while swaps and futures can alter systematic risk exposure. By isolating and managing specific risks, derivatives enable portfolio managers to tailor portfolio characteristics to client objectives. Effective risk management through derivatives helps preserve capital, reduce volatility, and improve the consistency of portfolio outcomes across different market environments. Derivatives also facilitate the creation of synthetic exposures. Through combinations of swaps, futures, forwards, and options, investors can replicate the economic performance of underlying assets without directly owning them. Synthetic positions can provide exposure to equity markets, fixed income securities, currencies, or other risk factors while requiring less capital than direct investment. This capability allows managers to access markets efficiently, overcome investment restrictions, and implement strategies that may otherwise be difficult or expensive. Synthetic exposures also support leverage and enhance portfolio flexibility. The program emphasizes that understanding synthetic replication is essential because many institutional investment strategies rely heavily on derivative-based portfolio construction techniques. Another important use of derivatives is inferring market expectations. Derivative prices contain information about future interest rates, currency values, volatility levels, and investor sentiment. Forward rates, futures prices, and option-implied volatilities provide valuable insights into market consensus regarding future economic and financial conditions. Portfolio managers analyze this information when developing investment strategies, evaluating risks, and assessing relative value opportunities. Consequently, derivatives serve not only as risk management and implementation tools but also as sources of market intelligence. For candidates, understanding how derivatives support asset allocation, rebalancing, hedging, synthetic exposures, and market analysis is critical because these applications represent core functions of derivatives within institutional portfolio management.